Hi everyone, welcome back to our channel. Today's topic is going to be the best tax ETFs to buy for long-term growth. How to use diversified investment strategies for the next decade. The technology sector has consistently been one of the most dynamic and high-growth areas of the stock market. From artificial intelligence and cloud computing to semiconductors and cybersecurity, tech companies continue to drive innovation and reshape industries. For investors seeking long-term growth, exchange-traded funds or ETFs offer a diversified and cost-effective way to gain exposure to the sector without the risks of picking individual stocks. In this video, we will explore the best tech ETFs to buy now for long-term growth, analyzing their performance, holdings, expense ratios, and future potential. Whether you're a new investor or an experienced one, this is going to be an important video to understand and capitalize on the ongoing tech revolution. So, let's see why invest in tech ETFs. It's important to understand why tech ETFs are a compelling investment, both for individual as well as large investors. Here are some issues to consider. Number one, diversification. Instead of betting on a single company, ETFs help us spread risk across multiple high-growth tech firms, and this reduces volatility of their overall portfolio while still allowing investors to benefit from sector-wide trends. So instead of picking a particular stock and trying to be lucky with the selection, the use of ETFs allow us to diversify and have a much larger base of investment, which reduces the risk. Cost efficiency. Many ETFs have very low expensive ratios, and they are often below 0.5, making them a cheaper alternative to actively managed funds. So traditional managed funds, they will try to give you an edge over the market by doing stock picking, and however they have a cost expense ratio, and if you use ETFs you can reduce this expense ratio, which is beneficial for the long-term investment. Exposure to mega trends. If you are looking for trends like AI, cloud computing, automation, and 5G, these ETFs will provide you a broad exposure to such trends without requiring deep stock picking expertise. Okay, so these ETFs, they are created exactly to uncover companies in this particular trend, whatever is the new trend that you're trying to invest, and this is going to be done by competent and professional investors. Strong historical performance. Over the last decade, ETFs like QQQ, Invesco Trust, have significantly outperformed the broader market. Now, let's examine the top tech ETFs. So here is an overview of these top tech ETFs. We have broad technology focus, QQQ. We have another that is pure tech, VGT. We have an ETF, SMH, which is based on semiconductor companies. IGV is an ETF that is tracking software companies. AIQ is an ETF based on AI and technology trends. And finally, we are going to look at ARKK, which is an ETF that tries to invest on disruptive technology. First, let's talk about Invesco QQQ Trust. The Invesco QQQ Trust is one of the most popular and high-performing tech ETFs, and it tracks the Nasdaq 100 index, which includes the 100 largest non-financial companies listed on the Nasdaq. The top holdings on this ETF are what we call the Magnificent Seven, and these are the largest technology companies in the US: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla. The performance of this ETF has been staggering. Over the past decade, QQQ has delivered 400% return, more than 400% return, far outpacing the growth of the S&P 500. The expense ratio of this ETF is very small compared to other ETFs, making it a cost-effective choice for long-term investors. Why should we buy QQQ for long-term growth? QQQ is heavily weighted towards the Magnificent Seven tech giants, which dominate AI, cloud computing, and digital advertisement. These companies have strong cash flow, innovation pipelines, and global reach, making them resilient long-term investments. Additionally, the Nasdaq 100 focuses on growth-oriented firms and ensures exposure to future tech leaders. So one example is Nvidia. Nvidia was until recently just one of the mid-cap companies that were trading on QQQ, and after a period of extremely fast growth, this company, Nvidia, has become one of the largest companies in the world. So QQQ was already invested in this company since several years ago. Next, let's talk about Vanguard Information Technologies, VGT. This is a company that is considered to be a pure tech exposure ETF, and it does not have other companies like communication services or consumer discretionary stocks, which some of them are included in QQQ. So this makes VGT a more focused ETF. So some of the features is it has many of the top holdings that we would find in QQQ, like for example Apple, Microsoft, Nvidia, Broadcom, and Adobe. The performance has been very good, 45% over 5 years, outperforming many sector-specific ETFs. And the expense ratio is very small, 0.09, one of the lowest in the ETF space. Why should we consider this for long-term growth? VGT provides focused exposure to hardware, software, and semiconductor companies. With AI driving demand for chips and enterprise software, this ETF is well positioned for sustained growth. Now let's look at Van Eck Semiconductor ETF, SMH. Semiconductors are the backbone of modern technology, powering everything from smartphones to AI data centers. The Van Eck Semiconductor ETF is a top pick for investors that are bullish on this critical sector. Some of the features of this SMH ETF are the following. Top holdings include Nvidia, Taiwan Semiconductor, TSM, ASML, which is a company from Netherlands, Broadcom, and Advanced Micro Devices, AMD. Performance of SMH has surged 55% over 5 years, And this has been thanks to the demand for AI-driven chips. Expense ratio of this ETF is 0.35, which is reasonable for focused and specialized ETF. Why should you consider this ETF? The AI revolution is fueling unprecedented demand for high-performance chips. NVIDIA's GPUs now dominate AI training, while TSMC manufactures chips for companies like Apple, AMD, and others. With global semiconductor shortage still being a concern, SMH offers a strategic way to capitalize on this trend. Another ETF that we are going to consider is IGV. While hardware gets much attention, software is where much of the tech industry profitability lies. The iShares expanded tech software ETF that trades as IGV focused on leading software companies. Here are some of the features of this ETF. It has its top holdings: Microsoft, Adobe, Oracle, Salesforce, CRM, and Intuit. The performance of this ETF has returned 52.84% over 5 years, reflecting its strong focus on software as a service, which is a growth segment of the market. The expense ratio is 0.41, which is a little bit higher than the ones that we have seen, but this is justified by its niche focus. Why should you consider IGV as an investment vehicle? Well, cloud computing, cybersecurity, and AI-powered software tools are reshaping the software business. For example, Microsoft Azure and Adobe's AI integration are highlighting how software firms are now embedding AI into their products, ensuring long-term relevance. Next, let's look at AIQ, Global X Artificial Intelligence and Technology. For investors who want direct exposure to AI, the Global X Artificial Intelligence and Technology ETF, trading as AIQ, is a compelling option. The top holdings are NVIDIA, Alphabet, Microsoft, Meta, and Tesla. The performance has been 52.94% over 5 years, benefiting from AI adoption in the broad market. The expense ratio is a little higher than usual, 0.68, but is reasonable for a thematic fund. In other words, they have professionals who are doing the picking of stocks that match the goals for the long term in this ETF. Why should you consider this for long-term growth? Well, AI is expected to add $15 trillion to the global economy by year 2030. AIQ invests in companies that are leading AI research, automation, and machine learning, making this a future-proof choice. Finally, let's look at this ETF, ARKK. For investors that are willing to take higher risks and investing in disruptive innovation, ARKK ETF that is led by Cathy Wood targets cutting-edge technologies like AI, robotics, and biotech. So the top holdings for ARQQ are currently Tesla, Coinbase, Roku, and CRISPR Therapeutics, CRSP. The performance of ARKK has been volatile, but it still delivered 70% over 5 years. The expense ratio is 0.75, which is a little bit higher, but not so expensive for the kind of investment strategy that they are using. So why should we consider this ETF? While riskier than other ETFs, because it invests on companies that are still not because it invests in newer companies. Our ARKK is always trying to invest in future tech leaders before they become mainstream. If even a few holdings succeed, for example, AI-driven biotech or autonomous vehicles, the returns could be substantial. So basically, the idea of investing in ARKQQ is to have an option of getting exposure to these companies that are still small, but they are very promising for the future. So one example of company that was an early investment in by ARKK was Tesla, and everybody knows nowadays that Tesla has grown in a fantastic way in the last few years. So this is the kind of companies that are target of ARKK. So how do you go about choosing the right tech ETF? You should look at some features of this ETF and make a decision. For example, for conservative and core exposure, one should probably pick QQQ or VGT because they are invested on established companies. If you are trying to focus on mega trends that are going on in technology, you can try to use ETFs like SMH, AIQ, and IGV. So basically, SMH will invest in AI and chips companies. AIQ will basically try to track AI developments, and IGV will target cloud computing and software as a service. And finally, if you are trying to be aggressive and buy companies that are possibly becoming large companies in the future due to its innovation, you should allocate some of your portfolio to ARQQ. So some investment strategy tips that you can follow is to use dollar cost average to mitigate your risks. So this means that you are going to invest in these ETFs over a longer period of time, and so you don't need to commit large amounts of money. Diversification. So basically, you even though ETFs are already diversified, but you don't want to be to have your whole portfolio in just one or two areas. So it's better to combine broader ETFs like QQQ with some money allocated to thematic ETFs. And also, you should consider this as a long-term view. In other words, look at tech growth that compounds over time, because the issue is technology is a kind of investment that is fluctuates very quickly. So in some years, you're going to have large growth, but you can also have situations where these technology companies, they lose value and sometimes faster than more conservative companies. So that's why the long-term view is very important. So some final thoughts for this is the tech ETFs try to align themselves with broader trends like AI, cloud computing, and automation. We should consider the strategic combination of these trends, and this offer a balance of growth and resilience to your portfolio. And finally, try to position your portfolio now for trends that will develop in the next decade or so. So that's the idea of some of these ETFs is trying to position your investments so that they will grow over time as technology develops. So that's what I had for today. Thank you for watching this video. If you like this kind of information, please subscribe, and I'll see you later. Bye bye.